The major central bankers of the world finally took notice that credit markets were frozen with fear and took a coordinated action to ease the mounting stress in the global financial system. Even China joined in, allowing its banks to lend more at a time when its manufacturing sector shows signs of slowing. It certainly gave moribund investment markets an adrenaline shot, that's for sure, but can it be sustained into a meaningful recovery? Neil Woolrich reports.
The decorations are up, but there's little to cheer about again this Christmas.
I'm not seeing anything that would suggest that business is getting better at the moment.
It's not a question of people not having the money or not having jobs to spend. It's a question of confidence, so a crisis of confidence.
Two of the big economic drivers in the global economy, notably the US and the euro area, are both misfiring at the same time.
We don't see much upside at all in the Australian market over the next 12 months.
Amidst all that gloom, though, markets jumped this week on news that 6 central banks will pump more cash into frozen credit markets in a desperate attempt to lower interest rates and stimulate lending.
This is actually the third time in the last 2.5 years that we've had an announcement about the Fed providing dollars to other central banks. On those last 2 times they made the announcement, we got a similar euphoric reaction from markets. That euphoria lasted 2 or 3 sessions.
The strains in the financial sector are still incredibly intense, and in fact they may well be getting worse. So we don't really know the strength of those European banks or what liquidity position they're in, but this sort of central bank action tells you that things could actually have gotten worse in the last sort of few months or so.
As 2011 draws to a close, European banks and governments remain snowed under by debt. And while the US shows occasional glimmers of recovery, its unemployment rate has been stuck above 9% for much of the past 3 years. That means investors are taking a safety-first approach into the new year.
For me, 2012 is still all going to be about capital preservation. So there's very little hope that I can see that things will be better, at least in the first half of this year. I don't think there's any magic solution to Europe. The political complexities are just so great that we're just going to be in this sort of, hopefully, a muddle-through kind of scenario.
But we've been on a path for a couple of years where the number one requirement for where we invest is will we get our money back. We're focusing more on things that preserve capital, fixed interest investments and property.
David Bryant is Head of Investments at Australian Unity and says when the firm is venturing into the share market, it's sticking with companies that have a proven track record.
Resources, Asia, large cash-rich companies, and brands and sectors that really transcend economic times. At a global level, the Walmarts, the Coca-Colas, in Australia, obviously the big mining companies.
And away from the share market, even fixed interest investments like government bonds are not the safe haven they once were.
I think if you can find genuine government bonds, and the reason for emphasising genuine is I want to distinguish the under-stressed bonds, for example, in Europe. Yes, I think they're a nice safe haven place to be. In Australia, we're blessed with one of the highest yielding AAA government bonds in the world. And that, to me, seems as good a place as any.
As governments and banks around the world now focus on paying down debt, the appetite for deal-making has also dried up.
I think they're bemused or confused as to really where it's all going. So I think there's a high level of confusion, and I think there's a general sense that nobody really knows where this is going to lead to and what's going to happen.
Chris Noblanche runs Citi's global banking business in Australia and New Zealand. He says the firm had a strong first half of the year, but investment banking, or raising funds for clients, was weak in the second half as global uncertainty weighed heavily.
Suffice to say that it's sufficiently in trouble in Europe that there will be very, very material implications for some time to come. So that's increased the level of caution around the boardrooms and within corporates as they look forward for the next 12 months to 2 years.
Much of Australia's recent growth has been hitched to China's seemingly unstoppable wagon.
but now even that seems to be running out of puff. This week, a government survey showed that China's manufacturing industry has shrunk for the first time in 3 years. And evidence has been mounting over several months that China's property bubble is just about to burst.
And I really think people are underestimating the consequences of that for Australia. You know, when you have commodity markets that are trading, you know, at bubble type levels, well above the demand supply kind of normal sort of pricing, then you get a fall in demand, has material impact on price.
Tim Rock says the Chinese property sector is in the early stages of a crisis, with prices falling and construction grinding to a halt. That will have serious implications for Australia's terms of trade, corporate profits and the federal budget.
The very important thing about China is that it's actually only the steel sector that really matters for Australia. You know, about 40% of our exports or so are really sort of linked into that steel sector. So it doesn't really matter what Chinese GDP does, what really matters is what that steel production does. And the big driver of that steel production is the property sector.
But Morgan Stanley's Gerard Minack has a more sanguine view of the Chinese dragon, even though he's anticipating some sort of slowdown.
We don't think there will be a Chinese recession, so I'd be looking to Asian markets and Asian economic growth to improve in the back half of next year in response to policy action.
So while Asia and the emerging economies provide some glimmer of hope, it seems the developed world still offers none.
It's going to be 2020 or beyond before Europe really, I think, gets back on a meaningful growth path.
They're going to have a recession, and that's a slam dunk certainty. The only question is whether it's a relatively mild recession or it's a deep recession.
You're not going to make any real material sort of change to that debt situation until economies start to recover, for one, and that's not going to be for at least a couple of years.
On top of all that, many major economies face elections next year, most notably the United States. Economic tensions could well make politics more bitter and partisan the world over, increasing the risk that important reforms over recent decades could start to be unwound, making a fraught investment landscape even more treacherous.